Again, this is just more of the same. You can exchange securities in exchange for an asset. We already said that, okay? And we already also said that usually occurs when small companies are incorporating. They'll exchange stock for some assets that they need, okay? And again, the same idea. You value the assets at the fair value of the securities that you give or the fair value of the assets you receive, whichever is clearer. It's the same thing. I'm just stating it in a different way. Okay, sometimes you need an appraisal to figure that out. Okay, sometimes you don't know what the value of your stock is, or you don't know necessarily what the value of that asset is. You have to get an appraisal. Okay. So let's take a look. Exercise 10.3. Exercise 10.3 is just going to walk us through the purchase of some equipment that's purchased in different ways, and we have to figure out how to record that. How do we journalize these purchases? Okay. Absolutely. Okay, so E10.3, exercise 10.3. Okay, so the first one is pretty simple. It's just what the consideration is that you exchange. Okay. The second one gives you, they tell you that you pay a down payment of $2,000. And the best advice I can give you when you're thinking about transactions happening, these are things that you may do in your life, right? You go in and you say, well, I'm going to give a down payment, I'll take out a loan for the rest, okay? So if you're going to pay back if you're going to be paying back $18,000 in the future, do you have to have $18,000 in the bank today to pay that back in the future? No. So they're really accepting some lower overall consideration. So you take the present value of that $18,000. They tell you the prevailing rate of interest is 10%, and it's for 1 year, so it becomes $16,364 plus you gave $2,000 down. So what you're really paying is $18,364. Okay. At the same time, you have a note payable you have to put on your books for $18,000. You just have cash going out of $2,000. It balances with a discount on the note. Okay. This is kind of a standard, we see things like this a lot happening in this class and in various contexts. Okay, notes receivable. Here's a note payable. In the next scenario, you have inventory. Okay, that you have inventory that is on your books at $12,000 that you would normally sell for $15,200. Okay, in this context, this is the clearer. This is really what your. This is the clearer of the two prices. Okay. So it's on your books at the 15.2. If they use the periodic inventory. Because so then you're not recording the cost of goods sold, so you're not taking it out of inventory at the time, right? Then you would just right. You would have, no, you wouldn't even, you would just take it off your books at the end of the period, right? Because you would record the cost of goods sold at the end of the period. So that's a good question, right? Because you would eliminate this middle section here, right? Because you don't record that cost of goods sold in that inventory going out. Okay? And in the last case here, we have stock that we issue. Okay, it's just kind of highlighting these are different ways that companies may go about purchasing something. You may come across these scenarios for whatever company you end up working for. Okay, sometimes exchanges happen. You may see transactions like this that clients do. Okay, and again, you may be more likely to see things like this in smaller businesses where they're starting up. They don't necessarily have the cash on hand, but you make deals, right? I have something that you want. You have something that I want. Let's exchange, or I'll issue you stock. Okay, so the question is how to value that. Yes? Because the prevailing rate of interest is 10%. Right? If you were to put money into a bank, the idea is that if you say to somebody, I'm going to pay you $18,000 in a year, what do you have now? Right? And how is it going to get to that $18,000? It's going to get there because you have it in some bank account where the prevailing rate of interest is some amount. Okay, and so it says, right, that like the prevailing rate of interest, does it say something to that effect? 8%, they're just telling you that maybe what the, is it a dealership? Let me look. Yeah, 10% is the prevailing rate of interest. Sometimes, like, you can go to a dealership and they can give you some, like, they can say, you could finance something at 0.9% or 1 point. They have different percentages that they may deal with that is just for that, just in that auto industry, okay? Or that they have some deal to get you to come in and borrow, okay? That's not really the real borrowing rate. The real borrowing rate is what you'd have to borrow from a bank at, okay? So that 10% is really the prevailing rate. Yes?
When would we use the 8%?
You wouldn't unless you took out a loan from the car dealership. Okay? You see what I'm saying? Like, if I was to go to a car dealership, if I need to take out a loan for a car, okay, there's multiple ways I can do that. I mean, this is, I could go to a bank and take out a loan from a bank, or I can go to the car dealership, and car dealerships often have deals where they have like better rates of interest to try to bring you in to entice you to buy the car. Okay, so the only way you would use that rate of interest is if you take out a loan from that car dealership for the car. Okay? Make sense? Good. All right, so let's move on from this.